All right. I talk a lot about global dollar liquidity, not because I'm a pioneer in this space, but because I stand on the shoulders of giants like Michael Howe and Raoul Pal. Michael Howe is from Cross Border Capital and Raoul Pal from Real Vision GMI. And when I hear these two guys talk together, I am usually very excited. So this is an interview that happened a few days ago. The Dollar Fix is in the playbook for gold, tech, and Bitcoin, featuring Michael Howell on the Raoul Pal, the Journeyman YouTube channel. You guys got to go check that out. It's an hour interview. We won't go through the whole thing right now, but I want to pull out some key points that have to do with the global dollar cycle. All right? This is not just Bitcoin. There's all assets, all high-risk assets. So let's see what they have to say.
As things go, we got to be thinking of what could be the end game. I don't think there's anything on the horizon that could necessarily disrupt things, but there are clearly problems building. And I think, as we look into 2026 and probably beyond, there are factors to think about. And to my mind, the two biggest factors, number one is that there's a lot of debt that's got to be refinanced out there because debt was effectively termed out during the COVID crisis, large amounts when interest rates were zero. And that's coming back into markets to be refinanced really from sort of later this year, but through 26, 27.
So what he's talking about here, the liquidity cycle, is part of that is the credit cycle, the availability of dollars. And so he's saying that, hey, during COVID, when interest rates were 0%, a bunch of people, I say that like it's, going to a Black Friday sale. The markets basically refinanced their debt for like 5 years out at 0%. And now they have to refinance that debt, right? The way that rich people do it or companies do it or what have you is that they have to take out new debt to pay old debt. Right? They have to take out new debt to pay old debt.
Poor people do that too. It's called floating. It's credit card, and I think it's illegal.
It's illegal. It's illegal for small people, right? For larger people, it's fine. Too big to fail. So they have to refinance 0% or 1% interest debt at 5% or whatever the interest rates will be. So the idea is, can they get interest rates low enough in order to make that refinancing not too brutal? The higher that number is, when the refinancing happens, where they go, well, we have to default on it. Here's the keys. We're done.
But 5% doesn't sound like that much for rich people.
Well, the question is, will they accept that? If they don't have to accept it, if they could be like, well, I'd rather just lose what I have right now or whatever it is, why take on higher debt? And if it's 5% now, who's to say that it's not 9% in 4 years, in 5 years? So if they can't pay it, they can't pay it. Plus, they have to be allowed to refinance at that rate. Someone has to be like, yeah, you have the credit worthiness in order to do it. Well, you've been taking out loans at 0% interest rate for the last 15 years. You don't have any history of taking out loans at 5%. So maybe you don't have the credit worthiness in order to do it. And even if you want the money, you can't do it. Well, that's layoffs. That's companies close-ins. That's a problem. All right. So we've been waiting for this. That 0% interest. It's a rolling start or whatever. He's saying, hey, that stuff really starts to pick up and come into play starting 2026, 2027. All right.
And the other thing we must, remember is that, strong economies don't always have strong financial markets. And the fact is that you've got US tech companies currently investing, $1 billion a day in IT and infrastructure. And, over the course of a year or so, couple of years, that's going to take about $1 trillion out of markets, out of money markets. These are big amounts.
So what's good for the economy might not be good for financial markets. We all hear that, right? Bad news is good news for financial markets, because more cowbell, more money coming in, and the opposite could be true for the economy. So he's saying, hey, because this is a whole AI thing and tech thing, $1 billion a day are being reinvested inside of the economy, actual hardware, GPUs, and infrastructure, and all that sort of thing. He goes, well, if that money's being invested over there, it's not being put into the market. It's not buying back stock. It's not investing inside of the market. And so that's a liquidity drain from the financial markets. So what's good for the economy might not be good for markets, which is an understatement of a lifetime. Yeah.
I never thought about the money going into AI hardware is not being put into financial markets.
Precisely.
So the more I hear like Sam Altman, they're doing 500 billion for Stargate or whatever, you're like, wait a second, that's a lot of money.
Yeah, it's not all cut and dry, right? Because there's second order effects to that. So if more people are hired, more people have jobs because of all that sort of thing, more money can reinvest into the market. If that's happening, then maybe jobs don't get lost, or the higher paying jobs or whatever don't get lost in the way that we think. The flows for 401ks still continue. Passive investments still beds the market, and we still go up with lower volume. All kinds of things can happen. But he's saying what is happening is that $1 billion a day is being invested in non-market things.
Interesting.
Companies may be seeing decent profits growth, but their cash flows are really plunging. And that's got to be a problem for financial markets in particular.
So let's dig in.
Free cash flow is one of the metrics that people use in order to value a company, right? A stock for a company can crash 50% because they're doing what's necessary in order to build their product offering, but be bad for speculation for the market. So I'd be like, what do you mean you're not going to buy back $50 billion worth of stock? Like, yeah, we're going to use that money instead for CapEx. Oh, really? Sell the stock.
A little bit to the slowness of this cycle versus others. From our work is like, normally the liquidity cycle peaks around the business cycle peak. They're all related, and the business cycle has been super low. If you look at the ISM, it's been below 50, and the strongest correlation to that is rates have been too high for too long.
All right, just to point out here, God, it's such a rich video, so filled with information. So we have the business cycle is not the same thing as a liquidity cycle. There's all kinds of cycles that are at play. One of my favorite tweets I put out under the Sacred Profit X account is that any cycle that you are aware of, that you have knowledge of, provides you with free will. Any cycle that you are not aware of, that you don't understand, is your destiny. Well, these cycles come into play, and as they overlap with each other, they have these dynamics that occur because of it. And so the business cycle has to do with businesses open and closing, hiring, inventory, manufacturing, wholesale, refinement, all that stuff. All that supply chain stuff has to do with the business cycle. So you can imagine that if there's, let's say, a slowdown for the consumer end, where they're buying less, well, that sends a signal to the retailers to stock less, which sends a signal to the wholesalers to make less, or to sell less, to demand less from manufacturing. The refiners and all that decide to do less of the raw materials, and then it goes all the way up the chain. So then, and it goes back and forth. If consumers are buying more, or if there's a problem with the supply chain in some key area in the world, that might translate to less inventory down the line. And so these types of business cycle dynamics are constantly in play. So Raul's saying here that the business cycle doesn't seem to be picking up steam like what we expect. The ISM, which is a diffusion index that takes into consideration the sentiment of the middle participants within this. So if they think things are good, that number is above 50. If they think it's bad or it'll be worse in the future, it'll be below 50. And we've been expecting this sort of breakout. So here we have the ISM PMI. This is the Purchasing Managers Index. So you can imagine purchasing managers are exactly the people within the chain who have an ear towards the retail, the consumer on one end, and the raw materials, the manufacturing from the other end. Right? They're in charge of placing the inventory orders. And so when this number is below 50, that means on aggregate, the people surveyed for this believe that things will be worse in the future than they are now. And above 50, better. And so we've been basically oscillating around this area, anywhere between 46 and 50 since, let's call it, November 2022. It's been oscillating. And we're waiting for this breakout because we're normally used to this up, down process, right? And here we're not getting it. We're getting sideways. So it's strange. It's sort of like it wants to break out, but not exactly. So Raul is asking here, hey, what's going on with the business cycle from your point of view, from a liquidity front? Why is that not matching the liquidity dynamics that we're seeing? Because we've been seeing high liquidity, global dollar liquidity. All right, let's continue.
And that has kept the ISM lower than expected, which means it feels like it's elongated the liquidity cycle. So that's one factor that I'm looking at. The other one is the fact that they've been shoving everything into the bills market and not refining, in, let's say, the 5-year sector. That's kept this cyclicality. And I don't know if that structure is changing things because it requires ongoing liquidity as opposed to cyclical liquidity. So
very important. So the government, right? So we talked about the refinancing of market participants, or rather the business sector. But then you have the government that also needs to refinance their debt. Remember, the government is putting out bonds in order for people to lend money to the government, and then they have to pay interest on those bonds, right? Well, normally the bonds are refinanced at 5 years or more. That means you basically have this 4 to 5 year cycle that happens before the government needs to refinance their debt. Mm-hmm. But starting in the Biden administration, because of COVID, they needed to refinance quickly and get more money in, and so they refinanced the short end of the curve, the 2 year. Right? So they refinance, I think, trillions of dollars or something like that on the 2 year. That means when Trump came into office recently, they had to refinance the debt. And they're like, shoot, that's why they were so desperate. We got to get yields down. We got to get rates down. We got to get rates down. We got to get rates down, because they have to refinance trillions of dollars worth of debt. Well, they did it, but at the 2 year. So Raul's like, well, it was 2 years with Biden and 2 years with Trump. So that means there's a demand for liquidity. There's a demand for dollar injections to the government now faster than the 5 year cycle that we're normally used to. Well, how does that play with liquidity cycles? Right? Bitcoin is usually a 4 year cycle that it's on. 4 years on, 1 year off, 4 years on, 1 year off, something like that. So it's like, does it mess with that? The equities market is sort of the same thing. We're used to this ebb and flow with these cycles. So does the 2 year refinancing mess that up? Are we on 2 year cycles? And if it's 2 year cycles, that's no time at all, which means there has to be this constant pumping of liquidity somehow into the market, which is why what he's asking, is that why we've had a slower ramp up? Right? Bitcoin hasn't skyrocketed. The stock market hasn't skyrocketed. It's been all-time highs, but ebbing and flowing. He goes, is this the new thing that we're in, where it's every 2 years? Do we have to rechange our models?
That'd be crazy. Yeah. The knock-on effects of that would be fairly dramatic.
Yeah, it would mean Bitcoin don't look for a top. Don't look for 80% down and blow off tops.
Right.
Look for 30 to 50% down and it doubling every year or so. Maybe that's the case.
It'll also change elections, because if the elections are on a 4 year cycle, that has something to do with this, no?
Well, it's divisible by 2. So what happens is that's what he's saying. There would be a constant need for liquidity. Since you couldn't depend on the low of the cycle being not in an election season.
Right. Exactly.
Then you'd have to always provide the liquidity. So how are we going to do that, and how does that work? Like some parts of the market need to provide liquidity. Is it the public sector? Is it the private sector? Is it foreign investment? Is it taxes? Like what's going on? We need to provide the liquidity somehow. Is it the IMF? All kinds of stuff. So let's see.
Firstly, the business cycle and interest rates, and then whether the structure of where they've been issuing makes a difference.
Yeah, well, I think the first thing is we don't seem to have a business cycle. And if you look at almost any economy since the COVID crisis, everything's kind of flatlined. So there's no obvious business cycle around. And, we can conjecture as to why that may be. Is it because fiscal policy is dominant? Whatever. But the fact is that there's none. There is a liquidity cycle, and that seems to be paramount. And the interesting point is, which I'm sure you'll attest, is that, financial markets are responded not to the real economy, they're responded to the liquidity cycle. That's what's going on. So we need to understand this, like it or not. I mean, it's become the paramount issue in markets as far as we can see. So I think that's true. And I think your point that about bill issuance is really critical. And, the way that we've sort of, I suppose.
All right. So then he goes on to explain that sort of thing. So Michael Howe agrees, hey, forget the business cycle. We're on a liquidity cycle now. In the same way that the world changed after the global financial crisis and it all became about QE. And if you got the QE thing right, you've been long the market. Because now it's about the liquidity cycle. So follow what the liquidity cycle is doing. You're going to do well. If you start looking at business cycle, jobs, birth, death of businesses, productivity, output, if you're looking at all that stuff, you're looking at the wrong thing. Because markets aren't moving on that. They're not moving on earnings. They're not moving on any of these things. 2.1 million jobs gone and markets made all-time highs. We're not moving on that anymore, folks. We're moving on liquidity.
It feels like the markets, the financial markets, are on UBI now.
Well, it's not UBI, right? It's the Triffin's paradox. It's what happens when a country has the world reserve currency. You end up in these dynamics where you have the financialization of the economy. It's just that they're punctuated because of crises, right? These crises cause the financialization to happen sooner because the financialization is the solution to get the financial markets out of it. Because the whole idea is that, well, if we let the financial markets collapse, then what will happen? We'll lose all our money. Yeah, but that'll be good for the system, and we can recycle. We can start again from scratch, and we won't have all that debt, and we can actually get our heads above water. Yeah, but I'm going to lose my billions of dollars, so that's not going to happen. And I, for one, as a supporter for the holy global empire, am for the liquidity cycle. Let the printing continue. All right, here we're going to jump to this idea of monetary versus fiscal inflation. Let's hear it.
Fact is, you've got inflating asset markets, which is really attesting to the fact that you've got strong monetary inflation. And monetary inflation is not just a cycle, as we know, it's a trend, and that trend is accelerating. And I think what the world doesn't realize is that things have changed dramatically since COVID. We're in a world of monetary inflation, monetary debasement. It's not, as I keep stressing, it's not one of financial repression. It's one actually more, it's worse than that. It's actually monetary inflation. And you've got to start thinking about how to invest in a monetary inflation world.
Yeah, and
remember, monetary inflation, right? Inflation is more money chasing same goods. Well, monetary inflation means that those goods that are being chased is in the monetary system, in the financial markets, not in the regular mom and pop stuff. So he goes, we're in a world now that monetary inflation is the thing, not financial repression where the access to money and capital and credit is not available to the regular person. That's bad enough. We're in a situation where the basement of the currency is required in order to sustain the spending of the governments, and that's going to cause monetary inflation, which is asset prices go through the roof.
Asset prices will go,
and both
asset prices will go through the roof, but
Yes.
the amount of dollars people have will also go through the roof.
No. Remember, if the number go up let me put it this way. As housing prices go up, it doesn't cause inflation locally because you'd have to sell all those houses and that money be floating around the economy for it to then cause inflation. What happens is that the value of the house goes up, people can borrow against it and what have you and have more spending money, but it doesn't, and it increases some money within the system, but it doesn't increase it everywhere. So eggs won't go up in price, but housing will. Mm-hmm. So if the stock market goes up 100% from here, it doesn't mean that 50% of the market participants then sell the stock market. And then that money becomes available everywhere else. And so it's just that the nominal number for these assets go up in value. So those who have it now own an asset that yields more dollars in the future, but those dollars are worth less, right? And so you have that. So that does when inflation happens within the regular economy and the eggs go up in price, it doesn't make more eggs, right? It just makes the eggs more expensive. When the asset prices go up because of monetary inflation, it doesn't cause more of those assets to be created. It just means that you have more dollars in order to get it. And so it makes people who are not exposed to the markets hard for them to get access to the markets. And it makes the people who sell those assets at the higher price, part of that price increase is just the inflation rate of that they were paying. Mm-hmm. So they don't get more eggs, they don't get more back. But if they take that money, that instead of if they take those dollars, they only feel it if they take those dollars to buy other assets. Mm-hmm. So someone sells Microsoft to buy Google, they'll feel that difference, that inflation rate. If they take that money to buy something that has not been touched by the inflation rate, such as gas or eggs or whatever it is, then they'll feel that much richer. That's why to poor people who have assets and sell them, they seem like they're so well off. Whereas to rich people, they go, well, I can't buy that other monetary, that other asset in the financial markets because the price keeps going up. Mm-hmm. You know what I mean? They feel poor. The millionaire feels poor versus the billionaire, but to the $1,000 heir, the millionaire and billionaire are completely, they're on another planet.
Right.
Am I explaining that properly? The inflation happens within the monetary system. All right, let's jump to, there's so many good things in here. You guys got to take a look at that. Crowding to U.S. assets. Let's take a look at that.
I think absolutely. I think that's the reality of that chart. But it's been the reality for the last 15 years that there's a lot of money that has flowed into the US because the US is the bond market. It's global collateral, and they've got on top of that the added icing on top is the tech sector.
So, final question
so the US markets are still the most attractive of all the markets worldwide because everyone has to print money in order to deal with what they're doing with their government style. But U.S. assets, U.S. bonds, can be used as collateral, which means you can put your money into something, have that money, and then also use that to get more money, right? You can put up this collateral, U.S. bonds, as collateral to buy something else. So when you put $3 billion worth in U.S. treasuries, you don't lose access to that $3 billion. Think of it as liquid staking in Cardano. You don't lose access to that $3 billion. That $3 billion not only is generating an interest from having the bond, but can actually be used as collateral for other things. So you can buy other things. In the same way that people will take out equity from their home in order to buy something else. They don't lose their home unless they mess up with what they purchased and all that sort of thing. And so if you're going to put your money in any bonds, you want to put them in U.S. bonds, because they're the most in demand and guaranteed by the might and force, the blood, sweat, and tears of the United States.
That's why money's flowing into America.
Exactly. Money flows into the dollar, into bonds, into U.S. markets.
For you, so do you think the rate of
Sorry, Peter Schiff. We're still on top.
debasement or the increase in liquidity, the rate of change increases from here, going into this whole big, large refinancing, refunding period? So we should see a spike in all of that, or is it kind of more as steady as she goes?
The way that I think about it is to go back to this chart, which is looking at the ratio between debt and liquidity. And what this is really saying is that over the long term, financial stability demands a stable debt liquidity ratio. This is for the advanced economies. If you get debt growth, and I think debt growth is, let's take the US as a decent benchmark, debt growth is likely to be growing at something like 8 to 10% per annum, or that sort of magnitude. Then I think what you've got on top of that is equivalent liquidity growth, because you need a stable debt liquidity ratio. So liquidity has got to grow at pretty much the same rate. Now, what we know is that a lot of those projections, and I tend to use numbers that come from the Congressional Budget Office for want of any other source, they give decent long-term projections. The problem with the CBO numbers is they don't take into account recessions. And we know that recessions basically lead to big deficits And in the last couple of recessions, the US deficit's blown up by 4 to 5 percentage points of GDP. So you could be seeing actually a lot faster potential growth of debt anyway. So I think that these figures are of sort of 8 to 10% minimum figures. And that's what we ought to be thinking about. So, in that case, you've got to choose assets that are likely to give you that sort of return over the medium term. And there's not that many around. Certainly bonds don't do it.
All right. So just going to touch on that. My God, it's just like, I wish people were taught this sort of thing in school. I wish I was taught this sort of thing in school. All right, just to recap what he's saying over here. All right, he goes. He's not talking about debt to GDP, debt to productivity. He's talking about debt to liquidity. All right, he goes. There's a debt to liquidity ratio that's happening throughout, and so he goes. Well, we need to whatever debt is created, they need to provide liquidity at least equal to that, in order to keep the ratio steady. So he's like, well, if you want to predict how much liquidity will be injected into the system, look at how much debt is injected, because they have to pay it. Mm-hmm. So you're going to get at least that much. All right. Then he goes, that's not even, they don't even take into consideration in the government reporting recessions. Because in a recession, they stimulate the economy by with more debt. Right? So he goes, under normal circumstances, there's an 8 to 9% refinancing the debt that needs to be generated anyway. So he goes, take that as a floor. And then if we're going to head into recession, add that on top of there. More debt that needs to be generated. And then if you want to keep the liquidity ratio, the debt to liquidity ratio at around 1, you got to add that much liquidity, which is the monetary inflation, the money within the financial system that causes these asset prices to go up. But he goes, well, that'll cause asset prices to go up, but money will flow to those assets that go up faster than the debt percentage. You want to beat 9%. If you had the choice, hey, you could put your money into a bond that'll yield 5%, but you'll lose net 3 to 4% at the end of it because of inflation, monetary inflation. Or you can buy this other asset that goes up 12%, right? Which one would you buy? Well, obviously you'll buy the 12% one. But not all assets can have a 12% increase or a reliable 12% increase. That means more money will flow towards those assets that have an expectation of that can go up that much, either a history of or ability to. Well, what assets, Peter, do you think can reliably go up more than 9%?
Crypto,
tech, S&P. So that means money will sell out of bonds and go into the highest performing assets that are correlated with global liquidity. And with the increased global liquidity, they would have to go up that much more. Right? And so you go gold, Bitcoin, tech, and let's consider the Mag 7. That which performs will gain more and more. He goes, and we're going to see a liquidity increase that'll dwarf the liquidity increases that we've seen in the past, because the debt we're refinancing now is the COVID debt. So we got to finance more than that. So he goes, I mean, there's no point in buying any asset that's not correlated with liquidity and outperforms the debt ratio. There's no point. Why would you ever do that? Well, trillions of dollars all over the world also feel the same way. So he goes long term, Bitcoin, gold, baby, tech. No reason not to do that. And anyways, I don't want to speak for him. Go watch the video. You guys can see for yourself. I think it's absolutely fascinating. These cycles are destiny or free will, depending on how you see it. And any recession that comes, any drop in price, is an opportunity to buy the dip for a trend you know exists. The debt needs to be serviced. It can only be done through liquidity injections. And they're going to come up with all kinds of ways of generating that liquidity, whether that's through stablecoin issuance, whether that's through tax increases, whether that's through war or whatever it is. Like, they're going to get their liquidity come high or come hell or high water. And so really, really fascinating. And if you take a look more about the video, he talks more about the idea that the liquidity cycle peak he sees is around March 2026, which I thought was interesting because it matches exactly with my time frame. It matches exactly with one of the windows of weaknesses that Ken Carson talks about, the 4 periods of weakness throughout the year. 2 of them are in March and then September, and it would make total sense. Now, if we pair that with a video we did recently about Gareth Soloway, who's talking about, hey, Q1 dropped to $75,000 in Bitcoin, but then Virtual Bacon saying, well, right now I think the Bitcoin dominance is dropping and altcoin market is taking over. Well, you can see how the picture becomes a little bit clearer to me that if we get through September, October without a major thing, buy all the way till February, sell, buy back as a Bitcoin starts to fall. We get to $50,000 on Bitcoin by October of next year. We buy then again, maybe even sooner than that, and we're off to the races. The whole thing is so interesting, so fascinating. Thank you guys for watching. Thank you guys for watching. We'll be back again in the future with that much more sacred profit.
Not financial advice. Do your own research.
You're guaranteed to lose if you follow anything that I say. You get that, SEC? You get that?